Hello and welcome to Your Business, Your Wealth. My name is Paul Adams. I am joined, as always, by Corey Shepard, who is president of Sound Financial Group, a good friend of mine, co-host of Your Business, Your Wealth, and a man who I frustrated to one of the highest degrees I ever have right before the show because I'm so excited about this one. My exuberance got the best of me, Corey.
I thought we decided that the episode was just going to be my intro for 15 minutes, just saying good things about me, and then we're going to just call it a day.
Yeah, I was going to use sandwich comments where it's like a good piece of bread, and then something in the middle you don't like. I learned that some HR workshop like when I was 12. I don't know. That was like the dumbest thing ever where you're like, I'm going to say something nice to somebody, and then I'm going to punch you in the gut, but I'm going to say something nice after.
I learned not to do that. It was like, because they said no one likes a poop sandwich. It says they didn't say poop. Yeah.
Absolutely. Well, y'all, we are here to talk about something kind of fun and exciting today. We just had this new bill passed called the Secure Act 2.0. And it is the second version of the Secure Act that now has some more options in it as it relates to you as a listener and what you can do with your 401k plan this year. There are a few of the topics that Corey is going to tell us which ones we're going to cover right now, so I don't mess that part up. But then we're going to go into a lightning round where in 30 seconds or less, it's going to go to Corey or I, and we're going to have to explain how that provision of the bill will affect you in 30 seconds or less. So with that, Corey, what provision are we? So these first ones we're going to talk about a little more in depth. Then we're going to go 30 seconds.
Without a 30-second timer, although we won't take too much longer, but they deserve some recognition. And this is compromise at work, y'all. This is negotiation. As a compromise to going through a 4-part series in depth on these. I agreed to. We tried to make it a competition. We just couldn't figure out the scoring in enough time, so it'll be for another day. So, a couple of big highlights, and then one final highlight at the end after our rapid fire round. So the first, expanded automatic enrollment in retirement plans. This is important for everybody who might be starting a new job to know that the tune of the automatic enrollment is heating up a little bit. Paul?
Yep. So it'll be by December 31st, 2024. that you're going to be required to do this. So when you start with an employer, they're going to be required to start you at 3% when you first enroll, increase it by 1% a year automatically until you reach 10%. Now, that doesn't mean you're not going to be able to be out of the plan. It just means like they're going to automatically increase it. And if you didn't want that to happen, you got to back it back down. So that's the automatic enrollment increase. You're going to see more and more automatically enroll you. And this all comes from studies out of some European countries where they noticed that they have huge organ donor signups. And the only difference between the countries that have really low organ donor signups and really high organ donor signups is the default box. And so they're kind of figuring that if you
in or opt out,
Yep. So they're trying to make it an opt out so that people are more likely to be able to save for the future.
Now that one goes into effect after December 31st, 2024. So This is how it is with everything government. There's big announcements. And of course, now there's the run up. So you have some time to figure out how these are going to impact you. Number two, the savers match. And this one is, it's kind of a funny switcheroo. And again, it only applies to incomes between $41,000 and $71,000 or for joint tax returns. And effectively the way I understand it, Paul, as I'm just reminding myself, is that this tax credit they used to get is going to now show up inside of your 401k.
Or so they're going to do something like if you prove you put that much into the 401k, then we'll give you the match. But that's another one that the implementation is until the end of 2023. So they're going to be...
2026.
Oh, sorry. I was on the student loan payments. Yes.
Yeah. Right.
Yep. So that one's not going to be till 26, but I'm assuming they're going to figure out some way to integrate you don't get your savers credit unless your CPA includes what you put in your 401k that year. Something like that.
So if your plan in the past was to spend your savers credit at the racetrack, you're not going to be able to do that anymore. It's going to land inside of your 401k.
That's right.
All right. The third big highlight before we go to our rapid round, and then our final piece of news at the end about a huge provision for everyone, is student loan payments as it relates to your 401k. So now you're allowed to not save for retirement and instead pay down your student loans.
Yep.
Is essentially what they're saying here.
What it looks like it would shape up as is something to the effect of, you would tell your employer, like, hey, I put 3% of my income to my student loans, so then the employer will give you the match. So that you just pay your student loans normal, but your student loan payments count as your deferral such that you'd qualify for the match. And the reason so much of this has to be done by regulation, y'all, is because the government has so much supervision in this, there is very little wiggle room. You know, like if you've ever gone to an employer the day after the new year and say, oh, can I please get some contribution for last year? I forgot. They're like, no. And not because we don't like you or don't want to, the law won't let us. So there's some other little things we're going to get into in the lightning round that show that there's like why couldn't you do that simple little thing before? And it's because the regulations didn't allow it. So there's going to be some things in here that seem like very common sense. Know that it sounds common sense because they banned common sense in these plans up until now, just because of the overburden of the regulation.
Right. All right.
And now I do have one extra dangle for our folks. I think there's two things that are really critical they should wait until the end on. So
okay.
I think one of them is going to be 30 seconds. We're going to cover it in line, but it's right near the end. So now, before we jump into this, I get into our lightning round. I want to give big props to this law firm, Williams Mullen. We're actually we did some searching to find who put together the best document on these changes. We're going to have a link to this posted to our website. But just right before we get off, I want to just specifically acknowledge all of the authors of this. Mark Parrington, Braden DeWitt, Nona Massengill, Allison Carlin, and Claire Pollock.
Allison did some great work on there. Claire.
Yeah.
Appreciate you.
Claire, especially appreciate you. But what is fun about doing this and walking you guys through this little bit of document is that you guys can get through and read all of this stuff. I would highly recommend everybody, especially if you're a business owner or an executive that's got a decent amount of money going to a plan, this document's well worth the read. This firm did a lot of work. It's just been posted in the last 24 hours, and I think it's the best summary out there. You can read it in a few minutes, but we're going to get a chance to go a little more in depth on some of these. So now I sent this to Corey and said, all I want to do is talk about the highlighted portions. And he said, we better do lightning round because there's a lot of them. It was
like, a bear coming out of hibernation, the glare of the yellow. So that's why we're doing it this way.
I have no idea how often Corey saves our audience from what I would have done otherwise. So, all right. So we're going to kick off our timer here. 30 seconds on the clock. It's rolling. So
improving coverage for part-time employees. Go.
Yep. So one of the things they're going to do is say after December 31st, 2024, if you have employees who work for you on a part-time basis over 500 hours, 3 years in a row, you got to allow them to participate in the 401k. Period. End of story. Pretty simple, but increased regulatory burden to the employer and possible opportunity the employee could get in sooner.
All right. This next one. Basically, the government's going to allow your employer to incentivize you to put money in the 401k by letting you win an Amazon gift card for a little bit of money so messes with our head, gamifies it a little bit. It's not any big dollar amounts, but after December 31st, 2022, they're allowed to kind of do some fun little games to help you put more in there. All right.
You can get Amazon gift card now. That's one of those common sense, wouldn't seem like it's a big deal. It was illegal before this. Now I'm getting this timer working right. Emergency savings accounts linked to individual retirement plans. Terrible idea. Terrible idea, Congress. Do not tell people your long-term savings, we're going to allow you to access up to $2,000 just because you've had an emergency. That is what it is. It's a terrible idea. Sorry, $2,500. You can put extra money into a separate little account that's supposed to be your emergency savings account, but it's in your 401k. I'm glad you did it. Give people more access to their money, but terrible idea. Corey.
All right, now the Department of Labor is going to have a lost and found for your retirement plan. So a database that you can look up any ERISA covered plan to see if you got some money out there. And I think this is a great idea. I have plenty of clients that after 2 or 3, 4 years of working together have remembered they had a plan that they even forgot to mention because it had been so long. So I think this can be good for a lot of people. All right, next.
Yeah, it's like the government's going to give us couch cushions.
Right. All higher catch-up limits.
All right, so you can contribute up to $10,000 now as catch-up contribution, or 50% more than the regular catch-up amount for individuals 60 through 63. So they're giving, for some reason, stopping at 63. You can't save after that, but you can put extra money in from 60 to 63 now, starting December 31st, 24.
Now, effective December 31st, 2023, any catch-up contributions for folks who are, that 50 or greater will automatically be Roth, which is pretty darn cool as an idea. Although I don't necessarily know that works the best for everyone. So that's just the blanket policies can tend to be a problem.
I'm going to go slightly long on this one. So wait for the buzzer. And now I'm still going to say on this one, what is key about that is it's high income earners. So over 145,000, then you're not going to be able to deduct anymore. So what the IRS is figuring out is they want that tax money now. They don't want to wait around. So they're going to let you put it in Roth, but they want the tax money today instead of deferring it. All right, next one. Amendments to increase benefits for previous planned years allowed until employer tax return date. So let's say you had a great year. And you as the employer said, what I want to do is give my employees a better match for last year because once all the books were done and closed in March of the following year, I realized I had enough money to do that. You can now do that as the employer. That was not possible before. Corey?
All right. Required minimum distributions as of now, January 2023, are going to be 73 instead of 72 prior. And that goes up to 75 starting 2033. So what does that mean? Financial advisors have a lot more to keep track of in our planning now. Our models are not as easy, but good news for everybody else.
Indeed.
All right, next.
I'm going to hit the next one that's later on in the document, but ties to this one. It's also going to drop the penalty for required minimum distributions if you miss them. They currently are 50%. They're dropping to 20%. And then I think it's like by the end of 2024, they get down to 10% like a regular IRS penalty.
All right, next one.
You got it.
There's mandatory retirement plan distributions to be automatically rolled over, meaning like if you leave the employer and you've got a de minimis amount in there, now up to $7,000, again, as of December 31st, 2023, gets automatically rolled over into an IRA.
Yep, so previously employers could just
catch those nickels in the couch cushions.
Indeed, indeed. All right, here's another one that kind of picks up on another. This is a little bit different than that savings account I talked about earlier. And simultaneously worse, we're going to allow people to just take a penalty-free withdrawal from their 401k for $1,000 for any self-assessed emergency. So terrible for the low-income earner that's a saver, but may save them from credit card debt, etc. Just the blending of emergencies and long-term savings is my concern. Corey.
Now, there's 3 more that go along with this. I'm just going to cover them. Penalty-free withdrawals in the case of domestic abuse, terminal illness, or federally declared disasters. So that last one was kind of like the COVID CARES Act. They're building some language in, just automatically help that happen. That's up to $22,000. 10% early distribution for terminal illness. That's just right now. That's in effect. And then the domestic abuse one is up to 50% of the participant's account, again, if they self-certify, which, it leaves some more ways that people can get money out, whether that's good or bad.
Well, and I got to tell you, the domestic abuse one is one I'm a big fan of because that might be especially in a married domestic abuse situation, that spouse may be shut out of family bank accounts. That 401k money might be the only money they get. And
So that was it. Yeah.
I'm personally really thankful they made that a decent limit. It's 10,000, but they didn't say anything about it being indexed for inflation. But that domestic abuse distribution is a long time
it is indexed
coming.
for inflation.
Oh,
that
good,
is,
good,
that
good.
is in here. Yeah. So
all right,
cool.
Next one. Exemption for certain automatic portability transactions. Now, this permits a retirement plan service provider to give that default IRA portability service for anything between $1,000 and $5,000 to allow it to be default rolled to an IRA. So this is an employer no longer wanting to pay the record keeping on all these employees that are in the plan but not doing anything in the plan. And they're going to allow them to just put those people in IRAs and then start sending their statements to their IRAs instead of being in the 401k.
All right. It used to be that Roth IRAs never had RMDs, required minimum distributions. Employer retirement plans and Roths were subject to some rules. Now that's all gone. So no RMDs for anything that says Roth ever. That's great. Love it.
Indeed. All right. Next one is the IRA catch-up contribution that's kind of been the same of 5,000, 6,000, like whatever they set it at each year is now indexed to inflation. Next.
Perfect. All right. One-time election for qualified charitable distribution to split interest entity, increase in qualified charitable distribution limitation. So exciting.
Do you want me to do the fast translation?
Yeah, because I didn't get a chance to read this one yet, so go for it.
You can give $50,000 of your IRA to a church or charity, and they can actually give you an annuity back. And previously, you could never do that with IRA money, and they left in the provision you could still give $100,000 directly. That's not what they call a split interest gift, where I'm leaving the principal to the charity, but I'm taking a little bit of income. They're going to allow that to happen with IRAs now.
Right. Now, this next one is pretty intriguing. So, 529s.
Oh, this is one I want them to wait for. We're going to make that the second to last one.
Oh, that's all right. So 529s is one of the things we're going to talk about. Okay.
At the end. Yep. So you take that next one.
Yeah.
The prohibited transaction.
Yeah. If an individual has multiple IRAs, only the IRA with respect to which a prohibited transaction occurs will be disqualified. So I'll give them an example of a prohibited transaction.
Buy real estate in your IRA, and then you take outside money and put it in to be able to improve the property. That would make all of your IRAs taxable. And they're saying now, no, just the one where you did the dumb move with the house.
So that's really useful for folks that want to do self-directed IRAs and do some of these real estate pieces. It makes it a lot
lowers the risk.
Lowers the risk a lot.
Indeed.
Yep.
Next one is if you start a small plan, you want to make sure that your CPA knows that you started the plan in the current year, because there are some tax credits available depending on how big you are and how much match you do for new employees. But you do get either a 50%, 75 or 100% credit depending on how big your company is and your employee count. You can actually get paid as the employer for some of the match you did for your employees.
That's cool. We also are allowing employers running simple plans to put an additional non-elective contribution in. So lesser of 10% of comp or $5,000, whichever is smaller, and that's indexed. But it's giving another provision for that profit sharing kind of activity that's available in other plans into a simple.
Yep. This next one, I think I can hit these next two really quick because they're fast.
Perfect.
They're increasing the limits basically on simple IRA plans to make them similar to a kind of a solo 401k plan. But what is also coming through in this legislation is a new tool nobody's talked about called the starter 401k, which doesn't exist yet. But now there's going to be something called the starter 401k that is going to exist. And then I'll just do the next one because I meant to do them together, Corey, is simple and SEP plans will now be able to have a Roth account as of December 31st. So I guarantee you none of the custodians have this figured out yet. But give them a couple of months and you'll be able to make contributions to SEP and Simple via your make them to Roth side of Simple and SEP accounts.
That's really exciting. Really exciting. And I didn't get to see this ahead of time, as y'all know. That's sometimes my my situation. But SEPs being so much easier to set up than 401ks, like solo 401ks, like for a lot of clients who could qualify for a solo K or a SEP, that Roth ability is one of the things that would have us steer them towards the complication of a solo K. But now a SEP with a Roth might be the way to, that's going to be big news for a lot of 1099 folks.
Indeed.
Okay.
Can I do the next one? Because it's my favorite provision left. There's two more left. But I can hit the two of them quick, and then we'll get to the special ones at the end, Corey. I'll let you cover those. This is a big deal. If you're a sole proprietor, let's say you're going to start a 401k. You can start your 401k, but the problem with starting your 401k, if let's say you started it right now, you can't put in a contribution for last year because the plan needed to be set up before the calendar year end last year. That was the rule until a couple weeks ago. Now the law is you have until you file your tax return much later in the year to be able to set up your retirement plan for last year. So even if you wanted to set up a 401k or otherwise, you can set it up for last year and make those contributions. Previously, that was only allowable on certain types of accounts, but now a 401k can be done retroactive, which was never possible before.
Super
and
cool.
Last but not least, if you have a 401k, you are going to have to rewrite your plan with all this stuff, and you're going to get a big plan amendment fee from your 401k provider. It's going to happen to everybody. So in advance, sorry about that to the American public. But on the upshot, if you're revisiting your retirement plan and you're going to have to plan for a restatement anyway, and you're not a client of ours, this might be a really good time to check in. Jeff, who introduced the episode, is our 401k expert, spent most of his career in group benefits, and we'd be more than happy to have you take another look at your plan. If some of these things are going to increase the cost to your plan, maybe it's a good time to reassess the plan. Corey, let's give them what we've been dangling.
Yep, the dangle, the two big ones. So I'll go first with the one I've been holding on to. All right, so for a long time, more and more employers have been adding a Roth option to the 401k, allowing you to direct your contributions to a Roth with a limit that is with no income limit like there is for the traditional Roths outside of those plans. So a lot of people have been able to put money into Roths, but that annoying employer contribution had to go to pre-tax the whole time. So, and
if they didn't have the in-plan conversion in there, you couldn't even switch it to Roth if your employer didn't have it.
To Roth later, right? Which a lot of plans didn't have the in-plan conversion. So a lot of folks, even though it didn't suit them and their aims to be building that tax deferred bucket, they had no choice.
Yes.
Now you're able to direct employer contributions to Roth. Now we got away from that, so I don't remember actually, is the deadline, is it starting a year from now, or is that supposed to be right away? Where is that? Retirement savings. No, that's on the top of this page. Mandatory domestic abuse. December 31st, 23. So this last...
End of this year.
End of this year. Yep. So...
And some of these are literally like a lawmaker going, kind of licking their finger, and they're sticking it up in the wind. They're like, I think it's going to take them about this long to get ready for this new rule. I don't know if you guys remember, when the Affordable Care Act was passed, in that was a rule that every single doctor needed to be totally paperless. And that was supposed to be done like, I don't know, what was that, 10 years ago? It was a long time ago. And no, I go to my doctor's office now, and it's like we're still requesting medical records, and people are sending them out to copy services. So these doctors didn't get it converted. My last fun one is, you guys know, if you've gone into our channel, if you haven't done it lately, search this channel if you're interested in college savings, because we have done some great content on the problems with 529 plans. Well, there's a pretty serious benefit now, is that lawmakers have said people are putting money into 529 plans, but they fully realize that if they get extra money trapped in the plan and they don't have another beneficiary to give it to, they got to pull it out with taxes and penalties. So you sent your kid to school, there's an extra $30,000 in there, you're going to pay taxes and penalties on that. What they said is, As long as the plan's been in place for over 15 years, you can roll it to your Roth IRA. Not to exceed $35,000 per beneficiary. And that will probably change with some regulations over time because that one's not getting implemented for a couple of years. But it is a key thing to know that previously where we had no exit from excess money inside of a 529 plan, we actually have a decent exit now that doesn't have to include the money being spent. So we're going to have some fun. And then what's also going to be fun as this gets implemented is there's going to be rules and more things are going to get released. We're going to say more things on these episodes. But as an example, some of the big moves we did for clients in shifting to Roth came out of the SAFE Act that was part of the COVID response by our government. So we can take some of these regulations when you work with an advisor that understands your aims, what you and your family want out of life. And then you couple that with an advisor's expertise and a willingness to engage and teach you these principles. Then over time, that team member is going to make you more efficient as you build your wealth. Just like something like this new piece of legislation comes out and, people like those of us at Sound Financial Group are digging through for every opportunity that we can to make that new rule that if we encounter it without knowledge might actually be detrimental. But if we encounter those new set of rules and laws and regulations with knowledge, we might actually be able to use them to our more effective advantage for our long-term wealth building. Corey, anything else you want to send people off on the Secure Act 2.0?
No, just make sure if any of these piqued your interest, or even if they didn't, take a look at the document and read through, because we did go fast, to see if anything jumps out to you.
And we haven't talked about it in a while, but if you click that in our show notes, in the comments, it'll be like the pinned comment, click on it. And what you're going to see is it's going to take you to a webpage for this episode. And in there is where we'll have links to any of our documentation, links, research, things you can download, etc. And, I want to just thank the entire team at Williams & Mullins this week, Corey, for helping our clients being able to design and build a good life. And we really look forward to seeing all of you next week, and welcome to 2023.